Good morning. As the market day begins, let's dive into a fascinating options strategy. Today we're breaking down the long put Condor. We'll explore its mechanics, benefits, and how it can fit into your overall investment approach. It's an options strategy that sounds complex at first glance, but is actually quite approachable, even for those relatively new to options trading. We'll simplify the concepts and walk through each step. It's specifically designed for those times when you expect a stock to stay within a certain range, exhibiting limited volatility and predictable movement. You anticipate the stock price not making any big moves up, remaining relatively stable, or down. You're essentially predicting a period of sideways consolidation. The goal? To generate a capital gain from a calm sideways market, capitalizing on the lack of significant price movement. You're betting the stock price will remain within a defined zone, a predetermined range that you believe the price will stay within. By a specific date, the expiration date of the options contracts you'll be using. This time component is crucial to the strategy's success. The long put Condor uses 4 put options, each with its own strike price, all with the same expiration date, ensuring they all mature at the same time, simplifying the management of the position. You buy 2 puts at different strikes, the highest and lowest strike prices in the Condor, and sell 2 puts at strikes in between, creating the wings of the Condor and defining the profit zone. This creates a profit zone in the middle, a range where the stock price needs to be at expiration for the strategy to be profitable. If the stock finishes there, within that defined profit zone, you win. It's a non-directional trade, meaning you don't need to accurately predict the direction of the stock. You don't need to predict up or down, which makes it suitable for uncertain market conditions. Just stability. The key is to identify a stock that's likely to remain range-bound. Think of it as building a structure, a carefully constructed options position, with a sweet spot for profit, a specific price range where the maximum profit is achieved. If the stock stays in that sweet spot, remaining within your defined range until expiration, your strategy pays off, generating a profit from a market that's not making big moves. It's a tool for investors, a valuable addition to your options trading arsenal. Who see opportunity in quiet, predictable markets where volatility is low and price movements are minimal? Let's see how it works in practice, examining a real-world example to illustrate the strategy's application. The long put Condor thrives not in the chaos of volatile markets, but in the serene predictability of sideways movement. It's a strategy designed to capitalize on stability. It excels in sideways, range-bound markets, where prices meander within a defined channel, offering a unique opportunity for profit. Picture a stock bouncing gently between 2 price levels for weeks, a clear ceiling and floor where there's no big news disrupting the calm and no wild swings causing unexpected turbulence. This is the environment where the long put Condor truly shines. That's the perfect, almost idyllic setup for this strategy to perform optimally. You carefully define a price range, identifying the upper and lower boundaries within which you expect the stock to finish at expiration, setting the stage for a potentially profitable outcome. If it obediently stays within that range as predicted, you profit handsomely, but if it unexpectedly breaks out of the channel, defying expectations, the trade doesn't work and losses can occur. This approach is fundamentally all about patience, waiting for the market to confirm your thesis and deliberately seeking out stability, not the adrenaline rush of high-stakes excitement. Time decay, or theta, that silent force in the options world, steadily works in your favor, because the options you sell as part of the Condor strategy lose value at a faster rate than the ones you buy to hedge your position, creating a net positive effect over time. As time gracefully passes and the stock stubbornly stays put within your defined range, your overall position steadily gains value, reflecting the power of time and stability. Therefore, look for stocks that have settled down and found their footing after the volatility of earnings announcements. Or focus your attention on companies operating in mature, stable industries, known for their predictable performance. Ultimately, you're actively seeking a lack of drama and excitement in the market, identifying stocks that are highly likely to stay comfortably in their lane, avoiding unexpected detours. The long-put Condor strategy richly rewards a calm and predictable market environment and demands a steady hand from the investor, capable of resisting the urge to chase fleeting opportunities. It's a strategy perfectly suited for those who value consistency and reliability in their investment returns over the fleeting and often deceptive allure of market fireworks and explosive gains. One of the best features of the long-put Condor is knowing your maximum profit and loss up front. The most you can lose is the net debit, the small amount you pay to open the trade. No matter what happens, your risk is capped at this initial cost. Your maximum profit is also limited. It's the difference between the middle strike prices minus your net debit. This trade-off gives you clarity and control. It's about aiming for consistent, modest gains, not home runs. You can size your position precisely, knowing exactly what's at stake. For risk-conscious investors, this defined structure is a huge advantage. Low volatility is crucial for the long-put Condor. Volatility measures how much a stock's price swings. High volatility means big moves. Low volatility means stability. You want to enter this trade when options are cheap, which happens in low volatility environments. High volatility makes options expensive and increases the risk of the stock breaking out of your profit zone. Low volatility suggests the stock will stay within your defined range. Use tools like implied volatility or IV rank to spot low volatility stocks. Look for stocks trading quietly, with no big events on the horizon. The ideal setup, sideways movement, and low implied volatility. That's when the long-put Condor has the highest chance of success. Let's dive into a practical example to see the long-put Condor strategy in action. We'll walk through a hypothetical scenario, step by step, so you can visualize how this strategy works in the real world. We'll use Microsoft, ticker symbol MSFT, as our example. Microsoft is a well-established company, making it a suitable candidate for this type of strategy. Suppose, for the sake of this example, that MSFT is currently trading at $450 per share. This is the price at which buyers and sellers are currently exchanging the stock. And let's say that the stock price has been relatively stable, stuck between $440 and $460 for a sustained period. This sideways trading pattern has persisted for several weeks, indicating a period of consolidation. Based on this price action, you anticipate that the stock price will likely remain within this defined range. You don't foresee any major catalysts that would push the price significantly higher or lower. You believe this pattern will hold true for the next month, giving you a specific time frame to work with for your options strategy. Given this outlook, you decide to implement a long-put Condor strategy, and you carefully choose 4 strike prices to define the structure of your trade. Those strike prices are $430, $440, $450, and $460. These strike prices will form the boundaries of your profit zone and define your risk. You select options that are all expiring in approximately 30 to 45 days, aligning with your expectation of continued price stability. Now, let's break down the specific components of the trade. First, you buy the put option with a strike price of $460. Next, you sell the put option with a strike price of $450. You also sell the put option with a strike price of $440. And finally, you buy the put option with a strike price of $430. This combination of buying and selling put options creates a defined profit zone. In this particular example, the profit zone is established between $440 and $450. There is an initial cost to establish this trade, which is known as your net debit. This represents the upfront investment required to put the strategy in place. In this scenario, the net debit might amount to $2.50 per share. Since options contracts typically represent 100 shares, this translates to a cost of $250 per contract. This initial debit of $250 represents your maximum potential risk on the trade. Now let's consider the potential outcomes. If MSFT's stock price finishes between $440 and $450 at the time of expiration, then you will realize a profit on this trade. However, if the stock price moves outside of that defined range, your potential loss is limited and capped at the initial debit of $250. This simplified example clearly illustrates how the long put Condor structure is designed to function. It provides a practical illustration of how this strategy can be applied in a real-world trading scenario. The primary goal is to capture a modest gain from a stock that exhibits a stable and predictable trading pattern. Now that we've explored the mechanics of the long put Condor, let's move on to see how to actually place this trade on your trading platform. Placing a long put Condor is easier than it sounds. Go to your broker's options trading section and select the stock, MSFT in our example. Choose an expiration date 45 days out. Select the Put Condor strategy, then pick your 4 strike prices: $430, $440, $450, $460. The platform will set up the trade. Buy the $430 and $460 puts. Sell the $440 and $450 puts. Enter the number of contracts and your limit price, say $2.50. Review the order to confirm everything is correct. Submit the trade as a single order. All 4 legs execute together. Your long put Condor is now open, simple, efficient, and controlled. Once your trade is live, patience is key. Monitor the stock price. Ideally, it stays between your 2 short strikes. Time decay works in your favor as expiration approaches. Check your position every few days, but don't overreact to small moves. If the stock nears your break-even points, consider closing early to limit losses. Otherwise, let the trade play out. Your maximum loss is already defined. The beauty of this strategy is knowing your risk and letting time do the work. Stay disciplined and stick to your plan. Exiting your long put Condor is straightforward. Many traders close early to lock in profits and avoid last-minute surprises. A common target is capturing 50% of the maximum potential profit. For our MSFT example, that's about $375 per contract. To close, go to your broker, find your Condor position, and select Close. The platform will reverse your original trade, selling what you bought, buying back what you sold. If the credit you receive is more than your initial debit, you've made a profit. If the trade goes against you, closing early can limit your loss. Knowing when to take profits or cut losses is key to long-term success. Smart exits are as important as smart entries. Is the long put Condor a fit for your style? If you prefer steady, defined risk trades over chasing big wins, this strategy could be ideal. It's best for neutral market outlooks, when you expect little movement. The capped risk and reward offer peace of mind, especially for risk-averse investors. It's also a great way to learn advanced options in a controlled setting. The Condor builds good habits, planning, discipline, and risk management. If you value clarity and consistency, the long put Condor deserves a place in your playbook. Sometimes the best opportunities are found in the quiet moments of the market. Thanks for watching. Good luck with your trading and see you next time.